Hey everyone, Justin Conroy, Financial Dad here, and today I want to answer some of the basic questions about credit cards because credit cards are some of the most highly discussed, highly debated topics in the personal finance space, and if you want to use them to your advantage, you need to understand them first. There's a lot of misinformation out there about credit cards, and I think this is one of the reasons why lots of people end up suffering because of them. So in this video, I'm going to answer some of the most common questions about credit cards, including what is a credit card, what are the different types of credit cards, how do credit cards work, how do credit card companies make money, how does interest get calculated, and finally, what is the right way to use a credit card. So by the end of this video, you'll have some of the basic knowledge you need to help use your credit cards to your advantage. With that, do me a big favor and smash that like button for the YouTube algorithm. Let's get this started. First, let's answer the question. What is a credit card? Well, simply put, a credit card is a way for you, the consumer, to have access to a very short-term loan, which we'll call a line of credit, for purchases that you want to make. Generally speaking, you carry around a piece of plastic with your name, an expiration date, and a credit card number, which gives you access to that credit line. When you're ready to make a purchase with a card, the merchant will use the information on your credit card to charge your credit line in place of receiving cash from you directly. The credit card company will pay your bill for you, and they'll keep track of your spending over time. Generally, credit card companies will track your spending over about 30 days, and they'll call that 30-day cycle a billing cycle, and at the end of each billing cycle, they'll send you a bill for the purchases that they made on your behalf. At that point, you pay off the debt to the credit card company over the next 20 to 30 days, depending on the credit card company, and you're basically going to rinse and repeat. So now that you have the basic overview, let's start unpacking all the details because there's actually quite a lot happening here. Let's start off with talking about the two different types of credit cards that are available, and those are the secured credit cards and unsecured credit cards. So what's the difference? The main difference between secured and unsecured credit cards is that secured credit cards require a down payment to actually have them. Basically, it works like this. You apply for a secured credit card, the company approves you, and then you send them a set amount of money, generally something between $250 and $1,000 up front. Whatever the number is, that number becomes your line of credit. See, secured credit cards are designed for people who have no credit or bad credit, and it's a way for credit card companies to hedge their bets a bit to protect themselves from the fact that you might rack up a bunch of debt and not pay your bill. You'll only be able to rack up as much debt as you deposited with them in the first place, so if you decide not to pay your bill, they've technically already got their money. What's in it for you, especially if you don't have a credit score or if you have a bad one, is the opportunity to use that credit card to improve your credit score to show to the credit reporting agencies that you are capable of managing debt. When it comes to unsecured credit cards, the only real difference here is that you don't have to submit the security deposit upon approval. Basically, you just apply for the card, and if you get approved, they'll send you a card with a limit of how much you can spend on it as long as you pay your bill on time every month. There's no problem. Unsecured cards are what most people carry around in their wallets, and this is what you'll ultimately upgrade to once your credit score is good enough. It means that you can potentially have a huge credit line available without having to put up that security deposit first. So the main difference between secured and unsecured credit cards is who can get approved for each, and whether or not you need to submit a security deposit up front. So regardless of which type you may get, you may be wondering at this point, how do credit card companies make money? So far, all we've done is use their credit lines and pay our bills. How do they stay in business? Well, there's actually a lot of ways that they make money. There's more than you can probably imagine. First, we've got all the fees. Now, luckily for you, if you play the credit card game right, most of these fees will never apply to you. So first, we've got balance transfer fees. These are typically charged when you transfer the balance from one credit card to another, and typically they'll charge you somewhere between 3 and 5% of the total value that you transfer. But if you never actually transfer a balance from one credit card to another, you'll never have to worry about that fee. Next, there's foreign transaction fees. If your card has foreign transaction fees, you'll basically get charged about 3% extra on top of each transaction you make while buying stuff in another country. Then there's cash advance fees. These get charged when you use your credit card to get a very short-term loan so that you can have some cash in your hands. So if you go to an ATM and use your credit card to get cash, you'll be subject to the cash advance fees. These can get super expensive because there's usually a flat fee or a percentage-based fee based on the amount that you pool, but usually you'll start getting charged interest immediately. I'll talk more about interest soon, but in general, interest doesn't usually start until you've carried a balance for more than a month, so cash advances are handled a little bit differently. Next, you have over-limit fees. These get charged when you charge more than your credit line. I mentioned earlier that you've typically got a credit limit that you can use your card for. So if, for example, your card has a limit of $2,000, your current billing cycle is already up to $1,950, and then you go somewhere and charge another $100 to the card, you'll be over the credit limit. Most likely, the card will still be accepted, but you'll be charged an over-limit fee. Usually it's a small set fee of about $25, but this can vary. Then we have late payment fees. I'm sure this is obvious, but basically if you get your bill and you don't pay it on time, you'll be charged a late payment fee. And finally, we have annual fees. This is probably one of the most widely known type of fees, but basically this is just a fee that you pay to have the card and use it. These can range in value from $0 up to over $10,000 per year to have certain cards. One thing to note about these fees is that all credit cards do things a little bit differently. Some of these fees are waived depending on the card, some of these are charging more than usual depending on the card, and everything in between. It's really important to always pay attention to your credit card agreement to make sure that you understand what your credit card charges for certain things. Moving on past the fees for the credit card holder, another way that credit card companies make their money is from the merchants themselves. Most people don't know this, but every time you swipe your card at a store, the store gets charged somewhere between 2.5% and 5% on each purchase. So even if you, as the card holder, never pay anything to the credit card companies, they're still getting plenty of money from the merchants themselves. Finally, when it comes to how credit card companies make money, we have the big one: credit card interest payments. Interest payments are one of the largest sources of revenue for credit card companies, coming in at about 40% of their total revenue each year. So this is a huge chunk of how they make their money. But this raises our next big question. How does interest on purchases actually get calculated? And how do people like me get away with never paying interest? Well, let's move over to my computer and I'll show you. So what I've got here on the screen is a spreadsheet that I put together that calculates credit card bills month to month. Now, one caveat here is that all credit card companies do things just a little bit differently, so you're not going to get an exact number using this spreadsheet, but it should give you a good idea and give you good, generally correct direction to understand how this all works. Second thing to note, I've used a spreadsheet similar to this in other videos, so if you've seen that before, I have made some changes to this since the last video, so please note there are a few little changes here. Basically what we have though in the white cells is data entry. So I'm going to go ahead and type in just to run through an example and show you how this works. Assume we have a 25% interest rate. I'm not going to make extra payments. We're only going to be paying the minimum. And I'm going to put $1,000 on my credit card, buying whatever I buy for that first month that I have the card. So we can walk through easily down here and see what that looks like. At the end of month one, I've made $1,000 in purchases. I have nothing on my previous balance because I just got the card. No interest because the month hasn't actually carried over yet. My new balance is $1,000. My minimum payment is $50 and that's what I'm going to pay. And so my total paid value is $50. Now, if we do nothing else on this example, if we just spent $1,000 and left it alone and only paid minimum payments, this is what it would look like from now on. So if you go to month two, we didn't make any new purchases. Our previous balance is $950 because we just paid the minimum. Now we have interest being calculated, and it comes in at about $20, and I'll talk about that in just a second. We add that interest to our old balance, so we get our new balance of $969.99. Our minimum payment is still about $50. We're not going to make any extras, and we've now paid another $50. And you can see how that rolls month to month. Month 3 here, month 4. We get all the way down to month 48 before we finally pay off the bill. So this is an important thing to note. If you've never seen how credit card interest gets calculated, it can be really dangerous if all you're doing is paying the minimum, okay? Because that's when the interest starts building up. We spent $1,000. It took 48 months to pay it off. And in the end, we ended up, I have some summations up here, we ended up paying $461.75 in interest. So we paid 46% more money than we actually purchased just in interest alone. This is huge. So what does this look like if we use the credit card more often but pay it off every month? I'm going to use my $1,000 here and I'm going to paste that down over the first 6 months. And instead of only paying the minimum payment of $50, we're actually going to pay $950 extra. So we're going to pay it off every month. I'm simulating this by paying $950 extra each month. So what you can see here is that we never actually get charged interest. This is exactly how I use my credit card every single month This is how I get away with collecting all sorts of rewards and never paying a dime in interest or fees, because you pay off the credit card every single month. One more thing to note about credit cards is the interest rate. The formula here gets a little bit complicated. You can see it up here on the top of the screen, but the basic idea here is that interest on credit cards is actually calculated at a daily interest rate. So this 25% gets divided by 365, and that gives you your daily interest rate of 0.07% every day. And most cards, what they do is they take your average daily balance throughout the month, and then they apply that daily interest rate to the card throughout the month, compounding every single day. And so this is another reason why credit cards are so dangerous. Most people think it's a monthly interest rate. It's actually a daily interest rate. There's daily compounding happening, which means that your stuff builds up pretty quick. And it actually means that if you have a credit card balance, it's better for you to pay it as frequently as possible to make sure that they're compounding as least amount of money as they possibly can. This brings us to our final and arguably most important question. How do you use credit cards the right way? How can you use credit cards to actually make yourself a profit? Well, it's actually very easy. First, make sure that you never pay interest. All you need to do is pay your statement balance in full each billing cycle, and you'll never be charged any interest. It's a big misconception that you get charged interest for every purchase. This just isn't the case. I use my credit card for every purchase I make, and I've never paid a dime in interest because I pay off the statement balance every month. If I ever missed it for some reason, then I'd be hit with some interest on the next bill. So as usual, live below your means, make sure you stay on your budget, and pay off the statement balance every month, and you'll have nothing to worry about. Next, take stock in your lifestyle and find a card that best suits it regarding fees. For example, if you travel overseas a lot, look for a card that doesn't have foreign transaction fees. Or if you need to transfer a balance from one card to another, look for a card with no balance transfer fees. When it comes to annual fees, I would say that in general, you should look for cards that don't have them, but there are definitely situations in which you might want to pay them. For example, if like me, before March of 2020, you were at an airport 3 to 4 times a week, you might want to pay for a card that gets you some lounge access so that you can have nicer seats, food, drinks, and fast internet while you wait for your flight. The point is, just make sure that you understand the fees that your card charges and make sure that you can minimize them. Or, if you're going to pay fees, they really need to be worth it. Finally, make sure your credit card is giving you some sort of reward. I didn't talk much about rewards in this video because I've got other videos that focus on those, but rewards are a huge part of credit cards and why they're worth using. So, similar to the fees, take stock of your lifestyle and find a card that rewards you for your specific spending habits. If you drive a lot, get a card that gives you extra rewards for gas. If you fly a lot, get a card that gives you extra rewards for airline flights. If you go to restaurants a lot, get a card that will reward you for it. If you do those things, you'll most likely never pay anything for your credit card, but only get rewards for using it. There's a lot of good reasons to have a credit card, but honestly, one of the biggest reasons is to increase your credit score. So do this. Click on the video on the screen right now, because in that video, I talk all about what credit scores are, how they work, and why having a good one can save you tens of thousands of dollars over your lifetime. Thanks for watching. We'll see you next time.